Hello, everyone, and welcome to the Indy Real Estate Investing Podcast. I'm your host, Jeremy Talllman, and with me once again today is Jared Shore. Jared is the owner of Mamba Mortgage here in Indianapolis. Welcome back to the show, Jared.
Yeah, I appreciate you having me. Excited to chat today.
Yeah, so there's a lot of talk about interest rates. We're not going to get into that today, but tell me, what is life like as a lender in late 2025?
Buckle up is really what the theme has been the last several years and even going into next year. But it's exciting. I think our industry has changed a lot over the last several years, and so it's been exciting. It's ever changing, and it forces us to be very creative and really get to know our clients a little more, because it's not just the standard loan that we're doing anymore. We really have to kind of dig deep and find what the why behind the want and customize those options. So it forces us to be, honestly better at our jobs, with the world changing. So yeah, I don't want to say this is a very hard industry to come in and be good at. And so, like I said, it just forces us to hone in on our skills, make sure we're very good at understanding guidelines, because guidelines are changing daily. If I feel like at this point that they're trying to adjust with the market as well and some of the changes. So it is definitely an exciting, keep you on your toes type of environment we're in right now.
Yeah, I'm guessing you're doing a lot of refis today.
We're doing more refis than what we've done in the last
Yeah.
few years. Yeah, obviously coming out of COVID was a huge refi environment, and it's just not now. Most of the refis we're doing are more on the investor side space. People doing hard money loans that either their goal was to hold it and refinancing out of a higher interest rate into a lower interest rate, longer term deal, or people that wanted to flip a house.
Yeah,
that the property's been sitting on the market for too long. They're like, let's kind of cut our losses here and refinance it and put a tenant in there. But we have
definitely done that over the years in my flipping days.
We have been doing a lot of refinances though on the primary residence side. So you got to think, there's been a lot of people buy houses in the last couple of years, and the rates have dropped enough where it makes sense for them to at least entertain the idea. And then we've also been doing a lot of HELOCs. I've done more HELOCs this year than I've done in my entire career.
Wow.
Just because a lot of there's a ton of equity in people's houses. But people are tied into these low interest rates that they refinanced for, back in the early 2020s here. So yeah, it's an ever changing market. We got to be on our toes. And the good thing is we've got a lot of products to fit everybody's needs there.
That's great. So Jared, I brought you on here today to talk about some recent news in the mortgage industry around the 50-year mortgage. We're going to spend some time on that. I also want to talk a little bit about the whole idea of a portable mortgage, because I think that's interesting as well. So again, these aren't in effect, right? You guys have had no guidance that, hey, this is now something you can offer. But I think we'll see. I'll get your opinion on if you think it's actually going to happen, or if it's just all conjecture. But let's start out with the 50-year mortgage. When you first heard about this news, Jared, what was your knee-jerk initial reaction to it?
I mean, I giggled really a little bit because it's not surprising that we're talking about it. But if you go back and look, even in the last 5 to 6 years, and more so specifically in the investor space, we have 40-year mortgages.
Right.
And so extending the term past 30 years isn't something like this brand new concept. It's new in the primary residence space, at least since the 30-year mortgage was created, right? And so there's a lot of things that have to happen for this 50-year mortgage to even take hold. One, the Dodd-Frank Act would have to be completely revamped, because the Dodd-Frank Act says that a qualified mortgage or a QM loan cannot exceed a 30-year term. Well, lenders could offer a 50-year loan, but it would fall outside of the QM, so it would be considered a non-QM or a non-qualified mortgage. And so the problem is that you don't have people on the back end, you don't have the secondary market, you don't have Wall Street buying these loans, because they're not guaranteed by Fannie, Freddie, and those deals. So it's going to take legislation and things like that for it to actually take hold.
Yeah, and what you mean by that is if you and I went together and opened a bank and we were self-funded, then we could make a loan for 75 years if we wanted
Yeah.
to,
Yeah, we
but
make
it's our
whatever we
own
want.
risk. Yeah, it's
Yes.
our own risk. So it's different from like a conforming loan to a portfolio loan, which they can kind of create their own rules in some ways because it's their capital or capital that's not guaranteed. It's at risk as opposed to again, those conventional mortgages that we all typically use.
Exactly.
So yeah, I guess my first thought, if I'm totally honest, was that's ridiculous.
Yeah.
Right. But then you kind of think about like, because I literally the first thing I thought, and I believe John with your group had told me initially about it, the 40-year mortgage that some investors were taking part of. And I think that was basically a 10-year interest. Tell me if I'm wrong, 10-year interest only, then converts to a 30-year traditional. Is that generally how they work?
There are some like that, but there are some that are just a straight 40-year amortized fixed rate loan, just like a 30-year loan. It's just spread out over an extra 10 years.
Wow.
And how many of those I've done? Zero. And this is why I don't know if the 40-year loan and investors love cash flow, right?
Yeah,
they love
they
cash
do.
flow. So if a 40-year loan is a better deal than a 30-year loan and it's that much more cash flow, you would think that investors would flock to this loan. It's just not a good product for cash flow because the interest rates are higher, which obviously drives the payment up a little bit, but also the way that loans are amortized. Most loans are interest heavy up front, so you don't see a huge decrease in monthly payment. It obviously is a lower payment, but it's not that much lower that it makes that much sense. So
let me read something to you. I got this from our friends at Evernest. They do a weekly newsletter, and it's mostly focused to investors out there, but it's a really quick little blurb. It says, housing affordability is tight enough that the White House is floating a 50-year mortgage to trim monthly payments. Expect a rate premium, which you just mentioned, over the 30-year, and I guess they're expecting between 42 and 57 basis points higher. Therefore, this is what the story says, if the 30-year rate sits at 6.22%, a 50-year rate might land at 6.64 to 6.69. So on a $400,000 loan, that stretches P&I, your principal and interest payment, from roughly $2,455 on a 30-year at 6.22 to about $2,297 on a 50-year at 6.64, which is about $158, a month break. That's about 7%. The trade-off is brutal in terms of lifetime cost and equity build. The 50-year term roughly doubles the total interest. It's almost $1 million on a 50-year AM on a $400,000 loan versus $483,000 in a 30-year example, and leaves you far more leveraged for far longer.
Yeah.
So thought that pretty much kind of put it into a nice little box, a few sentences here of what this looks like. So I'm curious, you mentioned this already. Why don't people do the 40-year, and why don't you think, presumably you think they probably won't flock to the 50-year. Why is that? Is it simply they're just more, like you mentioned, investors love cash flow. It's $158. Not a lot of cash flow. Let's be real about it. You can't do a lot with $158 a month. Why don't you think they'll flock to it? I'm just curious from your seat why you think that.
Because people aren't used to it yet, right? We're so ingrained to a 30-year mortgage, and we could run, what you just read there. You could also probably do that same analysis from a 15-year mortgage to a 30-year mortgage, right?
Absolutely,
and 100%. We did a long time ago when the 30-year, really came out. It was before my time doing mortgages, but the 30-year was like, oh my gosh, I'm signing up for a 30-year mortgage, and my assumption is that people were having the same conversations we are about that,
100%.
right? And so it's just not people, when you hear 40, you're like, I don't want to pay it for that long. And the reality is nobody's paying a 30-year mortgage that long. And so what I always tell people is like this, think about this. Okay. So the average time that somebody actually holds a mortgage is And it's probably, this number is going to extend because people aren't refinancing like they were, right? But
Right.
it used to be around 7
Yeah.
years or so.
Yeah.
And then what did people do? They refinanced. And if smart people did the refinance correctly, they'd refinance to a 20-year, a 25-year term to keep their term the same. Well, what do? They refinance back to a 30-year.
A
Well,
30.
now you just made that 30-year a 37-year loan,
Yeah.
right? And then you
Yeah.
do it again and you just made it a 45-year loan. And so people are tied into their mortgages for longer than 30 years anyway, just because of the way that we are so rate sensitive. We got to have that lower rate. We got to have cash flow in our daily lives. And the only way to do that is to continue to extend the loan and extend the loan by refinancing. And so we're tying people into longer terms anyway, just because that's the nature of what we want. We want cash flow. We don't look at the long term, but then we get a 50-year term. And the first thing we do is we look at, oh my God, look how much money I'm going to be paying over 50 years.
Yeah.
And, but short term, I don't think it's a terrible deal. In certain situations, if you have somebody who truly doesn't qualify for a house on a 30-year loan, and they do qualify on a 50-year loan, and maybe it's somebody who just got out of college, they're a doctor, they're in their residency, they're making very little money, they're going to be making a lot of money in the next 7 to 10 years. As their income increases, now they can refinance to lower terms, lower rates, and increase their monthly payment on their mortgage to coincide with their increased income. That to
Yeah.
me makes sense.
That's a
Or
great use case.
possibly makes
Yeah.
sense. And there are specific loans like that already for people like doctors and potential high income earners, where their payments go up according to their income. So that's a best use case on that. I don't think, there's things you can do and you should do, right? And they're not always one and the same. Buying a house, for us to conform guidelines to get more people into houses may not be the right thing to do, because if you have to have $150 dollars in extra cash flow to qualify for a mortgage, it may not be the right thing to do. It may be the right thing to do. That's relative to every single person, but it feels like we're just trying to squeeze everybody in to keep the housing market going. And here's why we're talking about 50-year mortgages. Here's an interesting stat for you. In 4 years, this is just a 4-year time frame. In 2021, have you ever heard of a buy rent gap percentage?
I've heard the term.
Yeah.
I can kind of, by the name of it, I can kind of figure out
Yeah,
what it is. But
it's basically which is more expensive or more
yeah.
affordable, renting or buying. In
Yeah.
2021, it was a 27% gap for the better to buy. So your payment will be 27% less, essentially. Right now in 2025, what do you think it is?
It's flipped, I'm
It
sure.
is 25% better to rent right now. And so if it's, and I don't think in the younger generation for sure, they're like, oh, why would I pay more to buy a house when I can pay less? And it's not just the monthly payment. It's the expenses to maintain the house. It's
Absolutely.
the time I got to go mow the yard. There's more stuff to it than just the monthly payment. So it is more expensive right now to buy a house than it is to rent. And I think that in the history of the US, at least, that has never been the case. It's always been more affordable and wealth building. So you get smart people that are like, I'm just going to go rent, throw that extra money and do an interest bearing account, and I can build my wealth in other ways than real estate. I think we've been sold on this idea that it is the only way to build wealth is through real estate, by buying a primary residence. And I don't know if that's
Right.
the case. And that those numbers, by the way, Indiana's in the top 10% of lowest buy rent gap. There are some, if you go out on the West Coast, some of the East Coast, it has been 120% difference from 2021 to now. I mean, it is a wild gap. So it's an epidemic. And so it's no wonder we're talking about 50-year mortgages when we're looking at this, trying to get the more people qualified for homes to keep the housing market, liquid.
Yeah. So you'd mentioned earlier about, when 30-year mortgages came about. I thought I'd spend a couple of minutes on going through the history of what our mortgages look like, because I think it speaks to what you were talking about. I think it's constructive. So kind of follow along with me, Jared. Jump in when you want
Yeah.
to. But so I had this beautiful little chart that I found online. And so the pre-1930s, all right, so we're talking about basically 100 years ago, all right, the typical mortgage term was 3 to 10 years. So we're talking like kind of like car loans almost today, not too different than a
Yep.
car loan. The interesting thing was, though, is that they were balloon loans and they were interest only. So every certain amount of years, however long it was, 3 through 10, you just got another mortgage. You kept going that way. So that's how it worked. Then the Depression hit, the Great Depression hit, and they started to do the 15 to 20-year amortizations again and they were fully amortized at that point.
Yep.
So you were paying a little bit of principal every month, again, to stimulate the economy, get housing flowing. And then between the 50s and the 70s, the 30-year mortgage took off
Yep.
again to stimulate the economy. That's where we saw, if you look at most suburbs, especially the first layer of suburbs, let's say like from Indianapolis's perspective, let's say like Northern Washington Township is a great example of that expansion. Those were all built in the 50s and the 70s, right? So we saw this massive sprawl out of the urban centers because of these favorable terms that people were getting. And like you mentioned, I wondered, I'm sure in the 50s, people were saying 30 years, that's ridiculous. I'm sure they had that same thought. And then it goes on where the 80s, they started doing ARMs, and that was really in response to very
Yep.
high interest rates that we suffered in the 80s. The 90s and 2000s, there were, again, you mentioned 40-year interest only came about, which they consider to be like for exotic mortgages. And then today, the 15 to 30 year is out there, the 30-year dominates. So it seems, a natural evolution of our economy, right? From when we started over 100 years ago. And I'm sure you go back even further than that, but they went from essentially like car loans to now we're talking 50-year loans.
Yep.
And again, I think it's that desire, that capitalistic spirit we have to keep our economy going, which housing obviously plays a major part of it. Anything surprise you in that, what I just went through? Or was that kind of like, yeah, I went to mortgage school, I know all that?
No, it doesn't surprise me. The interesting thing is that, when you go back to the 30s and 40s, right, and you're talking about very short term interest only loans.
Mhm.
And I was listening to a thing the other day with a guy who it was probably in the 50s maybe, where they were kind of transitioning from those short-term loans to a little bit longer terms. And what they did before, it was so much more common sense lending. They would go into it was more mom and pop shops who were lending on these houses versus bigger banks too. And they would go in and they'd have the serial numbers written down for all the appliances as well, because they're
Mhm.
lending on not just the house but everything inside of
Wow.
it too. And so, they wanted to know how many kids were in the household. They were really looking at residual income. And so they didn't have like a debt to income ratio. They had a residual income calculator that said, hey, if you have X number of people in the household, and you're paying a car note and this new mortgage, how much money do you have left over at the end of the month? And if it fit inside that residual income, cool, then you can support your family and buy a house too, and we'll lend on it. Thought that was really neat. I think it was more like that personal touch to it. Like, is this a good thing for you, and is it a good thing for us? And I think where it transitioned, it almost feels, at least the perception of where we're at right now, and some of the things I've seen on social media, is the only people winning here is the banks.
Yeah.
Um, and I don't know if that's the intention of the banks. I mean, obviously, banks want to make money, and the lenders want to make money. Um, but I truly think the heart of this is trying to help more people buy a home. The result of that is the banks are going to make a lot more money in interest.
Yeah, double. I mean,
Yeah.
but it's going to take them longer, obviously. But yes, there's a
Yeah.
lot more interest to make there. So, yeah, I Here's my own personal opinion on the 50-year mortgage. I think it puts the focus, and this is for investors. Okay, this is really for investors thinking about this. Because like you mentioned, everyone has their own story and reason why they may want to do this. And I'm not going to like judge that. But from an investor perspective, I think puts the it puts focus on the wrong area of investing in my mind. That's that cash flow versus equity gain. And the cash flow you gain, again, I'll say it again, opinion, at least in the numbers I just gave, which was a $400,000 mortgage, that cash flow is going to be, that spread's going to be even less on a $200,000, which is more common in central Indiana. I think it's at the end of the day, fairly negligible. Now, I do think there is a psychological element here that could cause some people to say, well, at least it's not negative. And they choose that option over a 30-year term. But again, $158 a month is certainly not going to build wealth. It never will.
No.
You build wealth when your residents help pay your mortgage and the market does what it does, and that equity,
Yep.
blossoms there. So any closing thoughts on the 50-year?
No, and I think what will be interesting, and obviously this is all, we're speculating on this, right? It's
Yeah,
not
absolutely.
even a real thing yet.
Yeah.
When we talk about investors, I don't even know if this will be available to investors. I don't know if this will be a primary residence, first time home buyer,
Yeah.
only option, or who it's going to be offered to. And that I think will be the interesting thing. And I think once we get kind of some more guidelines around it and parameters, then that's when we can figure out and be creative around, does this even make sense? Is this a short-term, option to, like the way I look at it is almost like an adjustable rate mortgage, where if the rates drop, then, you can always get out of that rate, that term,
Sure.
and change it. But what I think I don't want people to do, and this is where my fear is with something like this, because again, you just went through the timeline. We were going from 3 to 5 to 10 to 15 to 20, is the comfortability of something like this, where people get comfortable with a 50-year loan and
Yeah.
and now, the idea may be to go to a lower term and pay this thing off quicker. But if you're comfortable with a payment and you're comfortable with a lifestyle with that payment, it's hard to change. And
Yeah.
now it's like, well, we can just keep going.
100%. There's a lot more to talk about there. We'll probably move on, but
Yeah.
you hinted about this, and I think if a lot of people get approved only because they can qualify at 50 years and there's mass adoption, then that sets us up for a bubble and a housing crash. So, but that's
Yep.
a lot of speculation down the road. So, um, let's talk about portable mortgages. Can you give everyone kind of a quick rundown of what those look like and what they may look like if this ever happens?
Yeah. And again, speculation here, right? Because
Yeah.
it's not a thing right now. But if it were a thing, the idea around it is that, we have a lot of people that are tied into low interest rates and they don't want to sell. They maybe feel like they can't sell because you're going to go buy a property that's going to be more expensive than what you have right now, because houses have gone up since you refinanced back in COVID, and your interest rate's going to be double, triple in some cases. So your payment's going to skyrocket. So you're kind of the golden handcuffs of being tied. Well, but what if you want to move? What if you're trying to downsize or right size your house and move up? And the idea of this portable mortgage is that you can take the loan that you have on your current property and transfer it to another property and still keep the same terms and the same loan and same rate on it. You're just transferring it to a different asset, essentially. So that's,
Yeah.
in a nutshell, that's what it is.
It's a little different than an assumable, which, because I think it's a little different.
Yeah,
Maybe
because
I'm
an
wrong.
assumable mortgage, like if I was buying your house and your loan was assumable, I would call your lender, whoever owns your loan. I would get approved with that
Yeah.
lender to take over your mortgage, and it's a true sale. I'm just taking over the payments and transferring the ownership into my name, and any difference between the sale price and what you owe is what I would have to bring out of pocket. But what's happening there is the loan is staying with the asset. The person who owns or who's paying the asset or paying the loan changes. This
Yeah.
is the person is staying the same. The asset is changing.
Yeah. Yeah. Like, I think you explained it really well there. So the way I understand this, Jared, I did a little bit of looking into this and reading about it, is that it may be very hard to implement this because the way our banking system works in America is the loan is tied to the asset and then pooled into this large, our loans are all consolidated and bought and sold, different things
Yep.
happen. That'd be hard to pull that out. Is that what you're hearing? I mean, I guess, what are your own thoughts about the
Yeah.
feasibility of this happening?
This is one. I wish it was good. I wish this would be an easy thing to happen because actually from a mortgage lender perspective, I wish they wouldn't do it because it would take a lot of business away from us. But from a practicality, this is probably one of the better ideas in my opinion, but almost impossible to implement. I, I do. th- It, I think from some of the stuff I've read, and I'm not an expert in Canadian loans, but I
You're
think
not?
yeah, no, I think there's some other countries that do this in some
Yeah.
aspect, but it goes back to what's at the very beginning of mortgages here in the US. Their loan terms are very short. It's like a 2 to 5 year term. And so the asset isn't as important, right? I think where this gets really hard to implement, not and you mentioned it just with the pooling and buying of loans on the secondary market, is the rates on those loans, right? Rates are determined by a lot of different things. People's credit scores, the loan
Yeah.
to value on the property, the loan amount itself. And so when you're putting an interest rate together on a loan and a lot of it is tied to the current situation of a borrower and the property and what they're putting down and the equity position, and then you're moving it to another
Mm.
property, all those risk factors that those secondary market people are literally buying, the reason they're buying them is because of those parameters, and all those parameters just changed immediately. And so I don't know how they would do that and still keep the risk that they're taking on it equal or better, because I
Yeah.
don't think they're going to want obviously to transfer it and have a worse risk position than what they originally bought that from.
Yeah. Yeah. I'm with you. I think part of me thinks this is a great idea because, and you hit on it, the main reason that we saw a slowdown with purchases and why inventory continues to rise and days on market continues to rise a little bit is that people did not want to move.
No.
We and look on the property management side, this has been awesome for our clients in terms of renewals. Like, we're renewing at a rate we've never renewed at this last year particularly. And I just can't tell you the number I've talked about on this podcast, number of times I've talked to people or even heard people talk to say, I'm sitting at 3%. There's no way I'm moving.
Yeah.
Like, so we're remodeling or we're adding this, we're doing
Yep.
that. And so it did cause, a chill in the mortgage, in the housing market, that if they could somehow figure a way out, that this could be one solution. It's almost like a race to the bottom, though. It's like, I want to keep refinancing until I get back, to as low as possible. And it's almost like rent control. Like, I'm locked in. Like, I don't
Yep.
have to pay more for a mortgage if I don't want to. So I think it's interesting.
I mean, I had the same exact conversation at my son's basketball game
Hmm.
2 days ago. A lady that we've known for a long time. Actually, we bought our first houses together about the same week, I feel like.
Mm. Wow.
And she asked me, she was like, "Hey, what's the market doing?" She's like, "Our rate is so good. We have so much equity in our house." But she's like, "What are we supposed to do? Like, we sell it
Yeah.
and what are we supposed to buy?" They'd like to have some other features. Their family's grown a little since then, but they're like, we can't. Like, it would
Yeah.
it'd be financial, it would destroy them,
Wow. Yeah.
because of how much the payment would go up. It wouldn't make sense.
Yeah. Well, it's been great. Again, total speculation on our part about, I
Yeah.
mean, we're reporting kind of what is happening and what people are talking
Yeah.
about, but it'll be interesting to see if this all comes to fruition. I think probably, like you, I think the 50-year mortgage has a better chance But like you mentioned, it's not going to be like they're going to announce it next week. It's not like
Yeah.
I didn't even realize it's going to take a legislative change to make this happen. And
Well,
so,
they could do it. They could do it. It just won't be a,
right.
you know, it would have to be the lenders that want to decide to do it and offer it, but it would be a
Yeah.
non-QM loan. I think the bigger change that really wasn't announced a lot is the removal of minimum credit scores for conventional loans.
Oh,
Right now,
wow.
there are no minimum credit scores for conventional loans as long as we get an approval on it. I mean, there's used to it was like a 620 credit score. You could go down sometimes lower, but right now there's absolutely no minimum credit score for Fannie or Freddie loans. And there's some compensating factors that you really have to have. It's going to be harder to get an approval at those low credit scores, but if you have large down payments, a good income, lots of assets, I mean, you could be a low 500 borrower and still get a conventional loan.
Wow. I did not know that.
Mm-hmm.
That's pretty interesting.
Yep.
So yes, I think we all probably know some examples of people who didn't make great decisions, crushed their credit, but are high earners.
Yep.
And so they still have the ability, presumably at a higher rate, to qualify with something that begins in the fives of credit scores.
Yeah. The stats have shown that most people, the majority of people recently that have low credit, it's from a one-time event.
Yeah.
Maybe, they changed banks and they forgot to switch all their auto payments, and they had, every single debt that they had went 30 days late and their score dropped 100 points,
Yeah.
overnight. And they were like, crap, like that was a mistake. It wasn't like a
Yeah.
pattern of events that were happening. So,
Or a divorce
yeah.
when like no one wants to pay, and
Yeah.
so I absolutely I see that. So
Yep.
that's super, super interesting. I'm glad
Yep.
you brought that up because I was not aware of that. I think, look, and this is a different topic, but there's a lot of discussion around credit scores in our industry too, and how high we should value them. And I think it's interesting. My guess is there are going to be some changes that happen, um, because I think some data would show what you showed, that it doesn't automatically say they're a terrible risk
Yeah.
just because of the incomes there, and they've got a good jobs and all that good stuff. That's what really you're most concerned about.
Yep.
So interesting stuff. So I'll leave you with this. Will our great grandkids have a 100-year option?
I hope not.
Yeah, let's hope not. So Jared, if people want to reach out to you, how do they do that?
Yeah, you can reach out to me. Email is probably the easiest. It's Jared, Jared at mambamortgage.net. You can give me a call or text 317-584-7771 is my direct line. So
Great.
Yep. Follow us on Mamba Mortgage, on Facebook, all the Instagrams, the LinkedIns, all that fun stuff too.
Yeah. Yeah. You guys, I was just visiting your office and you got a podcast in there. It's super cool.
Yep.
Happy to see your success, and
Sure.
I appreciate you coming on here doing this.
Well, thank you for inviting me, and look forward to the next one.
Yeah. We'll be back in 2 weeks with another podcast. Until next time, thank you so much for listening, and please stay invested in your investment.